As economies slowly recover and life starts to look a little bit more normal, one industry is taking an unexpected turn. Car prices are finally dropping. Whether you're an eager buyer or a stunned window shopper, there's no denying the dramatic swing in the car market's prices recently. From a 45% increase in used car prices to a sudden drop of 8.8% in a span of just a few months, the market's been through a rollercoaster ride. Research shows that these dramatic price shifts have a deep impact on our buying decisions. We're more likely to buy when we spot a single large price drop, fearing a potential increase. On the other hand, we hesitate when we see prices soaring, anticipating a future decrease. Amid supply disruptions, dealerships have been charging customers even higher prices than their increasing costs, thereby hiking their profits. But now, with production increasing and interest-sensitive demand cooling, there might be pressures to reduce vehicle prices. What does this mean for the consumer? It means navigating the car market is more complex than ever. Before we look into this price drop, click that like and subscribe button and hit the notification bell to stay updated with our latest videos. This channel will keep you updated on the most intriguing videos on economic topics around the world. Over the past years, the car market has been up and down. The previous trend showed car prices skyrocketing, a fact largely driven by the high demand and limited supply. The Consumer Price Index for car prices reached a 13-year high in May 2021, and the average price for used cars shot up by 45% in the 12 months leading up to June 2021, a historic increase only surpassed in 1975. Several factors contributed to this price surge. High demand coupled with low supply due to the halting car production following the global computer chip shortage. The pandemic was another factor, as the shift to remote work and mass job losses led to a significant decline in car sales, reducing supply further. As the world began to rebound from the pandemic, the demand for cars increased. Many offices reopened, leading to a spike in demand for vehicles. Buyers with accumulated savings and low interest rates started to buy more, escalating prices further. However, a drastic shift is currently underway. 2023 could be a year of relative stability in the car market. As supply chain issues ease and vehicle supply increases, the prices of older used cars may face less pressure. Rising interest rates have made auto loans and leases more costly. This has led to a decrease in demand and, as a result, easing prices. Despite the softening prices, 2023 is not expected to be a year of car bargains. The whole car market is being reshaped, and the way cars are ordered and sold is evolving. But how much has the car market really shifted into a lower gear? A recent UBS report estimates that global car production will surpass sales by 6% this year, leading to an oversupply of 5 million vehicles, which will require significant price cuts to be sold. The car market, once riding high on record prices, is now witnessing a drastic shift. One example is Tesla, who slashed prices by up to £8,000 in the UK, bringing its cheaper models into the price range of mass-market brands such as Kia. Ford and Lucid followed suit, responding to Tesla's cuts by lowering their own EV prices. Meanwhile, used cars, which saw their largest annual increase of 45% in the 12 months leading up to June 2021, experienced a dramatic swing in the opposite direction with a 12-month drop of 8.8% as of December. The plunge in used car prices is the steepest since June 2009, when General Motors and Chrysler were both in bankruptcy proceedings and the economy was losing 500,000 jobs a month. In the backdrop of this price drop, we also see a decline in prices across all car segments. Recent data from Cox Automotive showed that the wholesale used vehicle prices in March fell 2.4% from a year earlier. But what are the reasons behind this sharp price decrease? One major factor is oversupply. As mentioned, an oversupply of 5 million vehicles is predicted, which will force prices down. In addition, supply chain issues that once led to high prices are beginning to ease, increasing vehicle supply and reducing pressure on the prices of older used cars. The market is also grappling with the effects of rising interest rates. The higher costs of auto loans and leases are making new cars, where interest rates are lower, more cost-effective than 2 to 3-year-old ones. This, combined with a possible recession in the first half of the upcoming year, is driving down demand and thereby slackening prices. The economic implications of these shifts in the car industry are profound. The auto industry's production problems, combined with global supply chain issues, were causing economic tremors. This is due in part to the industry's interconnectivity. A slowdown in car manufacturing impacts not just car makers, but also sectors like mining, tire production, and electronics. As noted by Ian Shepherdson, chief economist at Pantheon Macroeconomics, the auto industry issues are a very meaningful drag on growth and employment. The drop in car prices, both new and used, can be seen as a potential signal of a broader economic slowdown. High production costs also pushed up new car prices by an average of 4.2% year-over-year as of January 2023, fueling an increased demand for used cars, and as a result, the average price of used cars currently is tracking around 30% above pre-pandemic levels. But with the market finally changing, prices for new cars are expected to decline by about 2.5 to 5% and for used cars by roughly 10% in 2023. What does this mean for the future? In the short term, automakers have managed to offset some losses by raising prices. However, the market's volatility indicates that there could be a long and bumpy road ahead for both the car industry and the overall economy. In the long term, the ramifications could be significant. As the car industry accounts for about 3% of the global economic output, any shift in this industry from production rates to pricing changes can have a far-reaching impact. It's clear that the recent fluctuations in the car market are much more than just an industry trend. They're a symptom of broader economic shifts and a potential warning sign for future growth and stability. With all that said, the global car market is clearly in flux. From the surge of electric vehicles, political influences, to shifting consumer preferences, the industry is experiencing transformative changes. Whether you're a prospective car buyer or an existing car owner, navigating this situation can be challenging. Here are some strategies to help you make sense of the car market. As a prospective car buyer, your journey often begins online. From car reviews to dealership details, the internet serves as a reliable starting point. The first step is to define your needs. Are you interested in fuel economy, performance, or perhaps the newest electric vehicle technology? Make a list of potential vehicles that meet your criteria and look up customer reviews online. Reviews provide an authentic view of the car's performance, reliability, and overall satisfaction from real car users. Also, keep an eye out for news and articles about your shortlisted cars. Any significant recalls, issues, or breakthroughs in the industry will likely be reported on sites like BBC's Global Car Industry. Once you've gathered the necessary information, the next step is to visit dealerships. Always remember, the sticker car price is usually negotiable. It's crucial to compare prices from different dealers and be prepared to negotiate to get the best deal. Now, what about those who already own cars? With the rapid changes in the market, there's a risk of falling into negative equity, where your car's value is less than what you owe on it. This can be especially prevalent with new cars that depreciate quickly. The strategy to avoid falling into negative equity is to make a sizable down payment when buying. This ensures that you have some equity in the car from the start, reducing the likelihood of the loan exceeding the vehicle's value. Keep your car in good condition and stick to the recommended maintenance schedule. A well-maintained car has a higher resale value. Additionally, consider keeping your car for a longer period. The longer you own the car, the more you'll likely be able to build equity as you continue to make payments and the vehicle depreciates. Should you find yourself in negative equity, try not to panic. One option is to keep the car until you have positive equity. If you need to sell, understand you'll have to cover the difference between the sell price and what you owe. The car market can be unpredictable, but with careful research and sensible decision making, consumers can successfully navigate it. We hope this video helped you gain a better understanding of the current car market. If you have any recent experience, leave your comments below, and don't forget to like, share, and subscribe.